Read the tea leaves on this with me. Like we had another guest on. We were kind of trying to figure out, is there definitely a hint of a pause there? I mean, he said we're getting closer, but then Jay Powell also said they're data dependent, and then flat out said no decision on a pause was made today. So a lot of what I thought were mixed signals.
Well, I think they were trying to be very clear that there's no longer any predisposition that more rate hikes are needed. And that was most clear in the change in the forward guidance in the statement, where they went from saying that, they anticipated that additional rate hikes would be necessary to sort of suggesting they would be looking at a bunch of data to determine whether or not additional rate hikes would be necessary. And Powell pointed to that change in the press conference, calling it really significant. So I think they're trying to say now what we do going forward, it's going to be completely dependent on how the data play out. I think, and our view really is that the data are going to suggest that the Fed has done enough for now. And we do think that's the last rate hike of this cycle.
All right, so Jay Powell made it clear there's still data dependence. We have the jobs report coming up on Friday. We got another inflation report coming up next week, and then we still have the debt ceiling to deal with. I asked another guest, what's the biggest inflection point for the markets potentially? He thought it might be Apple earnings, but out of those three, those economic different things, what do you see as being the biggest?
Well, I do think that the inflation data have been really important here because in the face of weaker economic data that I do expect we're going to start to see, it's going to be those inflation numbers that give the Fed or determine whether or not the Fed has the room to react to the weaker numbers. If we get weak economic data, if we get weak earnings, if we get, trouble with the debt ceiling, the Fed's ability to respond to all of that by moving policy to a less restrictive stance is going to be determined by how high the inflation numbers are. So ultimately for the markets, that's, I think, the real key in terms of determining whether or not we will get rate cuts before the end of the year. Our forecast actually thinks that the inflation rate now, we do think will come down enough to give the Fed room to do so. But I think the inflation numbers are going to be key in terms of the market's expectation of how much the Fed can or cannot react to any of the other bad news.
Yeah, so I mean, Jay Powell really emphasized that inflation is coming down, but not quite fast enough for the Fed, at least not yet. So I want to turn your attention to one other thing, the banking crisis. We're seeing two regional banks falling pretty hard in the pre-market, PacWest and Western Alliance. How big of a factor is the banking crisis, not only for the Fed, but for the broader economy? Because on Monday, when JP Morgan bought First Republic, I think a lot of people felt like this was settled, at least in the near term.
Our view really is that the banking story is going to continue to be pretty, volatile, and in the sense that, we're not sure all the news is out, or that's something that, as you said on Monday, when everybody felt better, our view was like, we're not clear, it's not clear that this is over yet. And in terms of the macroeconomic implications, our view is really that this is going to contribute to a pretty significant credit crunch. And, we had been expecting that the economy would slow and dip into a recession in the second half of this year. All of these developments, and particularly the fact that they are even more likely to lead to sharper credit tightening than we had anticipated, that's going to be a very significant headwind, we believe, for the economy. And so, from our standpoint, it only makes us feel, unfortunately, more sure about the economy, underperforming, slipping into recession. And it does also make us feel more confident that inflation can get lower faster amidst this weaker economic backdrop. And again, as a result, we now actually think the Fed can cut rates before the end of the year, whereas before we really pushed back against market expectations of expecting something before 2024.
Wait one second, Michelle. Could, or do you actually think they will cut rates before the end of the year?
We do have yes, it's in our forecast that the Fed cuts interest rates in the fourth quarter of this year. Again, just trying to move policy back closer to neutral from a very restrictive stance, beginning that journey. We've got inflation coming down to just over 2.5% by the end of the year. And so, against that backdrop, I think the Fed would have room to move.